to Avitan Chair. And thank you, Chambers, for giving me this opportunity. I think, as Parag rightly mentioned, that it's a collective learning is what the motto of Chamber is. And I think my effort today is also going to be the same. So when Avitam gave me this topic, frankly speaking, I was a bit surprised because I said that what are the nuances? I mean, we all have read around the budget, we have attended seminars after the budget, spoken about it. But it's only when you truly, do a research for any speak or any teaching or any seminar that you really understand the nuances. So I think with this background, my purpose in next 1.5 hours would be that first what I have done is that I'll briefly introduce a topic, and then what I have done for ease of each of the participants, I have prepared certain FAQs which are there in my presentation. So I'll take the panel, take the participants through the FAQs. Wherever I feel that I need to add, I will add that. And at the end of FAQ, we have taken certain case studies. And thereafter, after the case studies, we will have a Q&A session subject to time allowing us. So that is the format which we will follow. So I think I'll just start sharing my screen. Avidan, is it visible?
Yes, just full screen. Yeah, visible.
Okay. Okay. Yeah. So friends, the topic today is old tax regime versus a new tax regime, and the focus of this session today is really more from individual, or as I would put it, other ways around, not from corporates or not from cooperative society. So really, today we will more discuss about the new tax regime, which was introduced by the finance minister in the budget of 2023. So that will be a focus area. Now, before we start and come to the FAQs and other thing, a brief background, because this seminar is open to all. So I'll just give. So today in tax law, I mean, whether we call it for individuals or broadly for individuals, HUF, AOPs, BO, etc. So today there is an old tax regime, which, so in the course of my presentation, we will use 3 words. One, we will use the word old tax regime, which essentially is the tax when you compute as per normal provisions after claiming deduction, exemption, and applying the rate specified in the schedule. That we will call it as tax regime. Then when we use the word new tax regime, there would be 2 things. First, when I speak of new tax regime, I would speak that the new tax regime was originally introduced by Finance Act 2020. Now, when that was introduced by introducing section 115 BAC, the finance minister really in her speech said that there are a lot of exemption deductions and there are a lot of riddles. And therefore, considering the fact that there were more than 100 exemption deduction, she started the new tax regime by introducing this section, and whereby she said that it's an optional section. And if you opt for this new tax regime, then around 70 deduction and exemption will go away. You will get a better different slab rates, which will prima facie reduce your tax liability. And that is good for the individual taxpayer as also for the administrator. So that is what was introduced in 2020 with effect from assessment year 21-22. Now, after 3 years, I mean, in Finance Act 2023, she now says that instead of the regime, the new tax regime being optional, now it's a default tax regime. So now, insofar as individuals and HUF were earlier also part of the new tax regime 1, if I may call it, now the new tax regime 2 will cover not only individual, but will also cover individual, HUF, AOP, BOI, and artificial jurisdiction person. And we have to bear in mind that this is a default tax regime. So one will have to opt out, and we will come through the provisions. So now, to summarize, there are 3 things: old tax regime, which is a normal tax which still prevails; new tax regime 1.0 introduced by Finance Act 2020 and really applicable up to assessment year 23-24. And now the default tax regime with the opt-out provision. So this is the way in which we will go about it. So we'll directly come to the frequently asked questions. In that format, I've tried to navigate this presentation. So as I explained to you, what is the old tax regime? So old tax regime is a regime which is applicable to all. In old tax regime, you compute tax as per the rate prescribed, but wherever specific rates are applicable, like short term, long term, etc., it will apply, and you will get all the deduction and exemption as permissible under law. Now the new tax regime background I have given, so I think we can skip question number 2. Now what is a new tax regime? As I said, NTR 1, as we call it, was only applicable to individuals and HUF. It was an optional tax regime. So if you wanted to opt in for the tax regime, in which event you would have to file certain forms within a stipulated period, then you would opt in the new tax regime. And in NTR 1, as one reads the law, there was a slab which will come to it, and there was certain deduction and exemption where a person would not get. There were certain losses, there was certain depreciation like additional depreciation which a person would not get. So that was under NTR 1, but one had to opt in the new tax regime. Insofar as NTR 2 is concerned, which was introduced now it is per se applicable to individuals, HUF, as well as AOP, BOI, and artificial jurisdiction person, applicable from AY 24-25, and it is a default tax regime. So if any individual HUF wants, it is a right to opt out. If we don't opt out within the permissible timelines and by filing the relevant declaration, it will be deemed that we are under new tax regime 2. So as we said, NTR 1 is applicable from assessment year 21-22 and up to 23-24. And what was tabled and now enacted by the Finance Act 2023 applies from assessment year 24. So for the financial year beginning 23-24. We already covered question number 4. And I have also explained that what do you mean by default tax regime? Is a regime by default, your tax would be computed in terms of 115 BSE 1A, and therefore you would not get a deduction of items specified under 115 BA 1 read with 2, 1A read with 2. Now, this is one of the question which is is asked by a lot of people who don't practice tax regularly, maybe salaried earners as well. That is it that the old tax regime, as we call it, has become redundant. Now, in my mind, if one sees the law and also sees the finance minister's speech, it is very clear that insofar as NTR 1 is concerned, it is an opt-in provision, and therefore OTR will have its relevance and will generally continue to apply unless I don't opt in for the new tax regime 1. And now, insofar as NTR 2 is concerned, it is by default tax regime, but citizens and all of us have a right to opt out. And therefore, if I want to opt out, I would be covered by the normal tax regime, which we call as the OTR. Now, what are the slab rates under NTR, so and OTR, etc.? So on the screen, you would see that under my normal tax regime, if I call it the old tax regime, if I can call it, there are slabs which are mentioned on the screen. If I'm an individual up to 60 years of age, then up to 2.5 lakhs my income is exempt, etc., etc. If I'm a senior citizen between 60 to 80, then that increases to 3 lakhs. And if I'm a super senior citizen, if I call it, age at 80 or more any time during the year, then I am exempt up to 5 lakhs. Now, as compared to that, when the finance minister introduced NTR 1, the tax slabs were you are exempt up to 2.5 lakhs. And thereafter, the tax slab was broken into 5, 10, 15% as will be visible from the screen. Now, as contrast to that, if one sees the NTR 2, so now I'm saying as a base slab, NTR 3, which is the default tax regime, is more beneficial because now I'm saying that up to 3 lakhs. So up to total income of up to 3 lakhs, I have nil tax. And thereafter, the duration of the slabs, or what I say, the range of the slabs have been increased. And therefore, only up to 15 lakhs, I've got 20%, and only above that, I directly fall within 30%. Important thing to note here, friends, is that while there is a distinction in the old tax regime between normal individual or senior or super senior, insofar as NTR 1 and 2 is concerned, it does not have any such distinction. Now, a very important question is that if someone asks us a question that what is the maximum amount that is not chargeable to tax if a person follows NTR? Now, here, in some people or some news items I have heard, they take up whether it's 7 lakhs. In my mind, it's not 7 lakhs, which is a minimum amount not chargeable to tax. Under NTR 2, friends, it would be income. If your total income is up to 3 lakhs, then it is nil. And the perception that up to 7 lakhs you don't have to pay a tax is really on account of the rebate under section 87A, and which again by this Finance Act has increased to rupees 25,000. So it is in that terms that a person says that, look, if my income is up to 7 lakhs, I am not paying tax. But if someone says under new tax regime, what is the minimum amount not chargeable to tax? Then if my total income is up to 3 lakhs, then it is not chargeable to tax. One. Now the next question, friends, is that is there a difference in the rate of surcharge and cess under the NTR and OTR? Now here, I think cess has remained the same throughout, so I don't think that changes. However, to further encourage NTR 2, and that only shows the direction in which the finance minister wants to go or the government wants to go, and that look, ultimately they want people to follow the default tax regime NTR 2, and therefore as a sweetener we are now being given to say that even if my income exceeds 5 crores, and let's say it's from not short term or dividend, etc., if it's any other income exceeding 5 crores, now under the old tax regime as well as under NTR 1, the surcharge, the highest surcharge was 37%, which would lead your tax to be more than 42%. So now, as a sweetener, the finance minister is saying that, look, if you follow the default tax regime NTR 2, then in that case, for other income, your surcharge will be pegged at 25%, and therefore your effective highest tax rate would not exceed 39%. So that is the only difference insofar as the surcharge is concerned. Now, this brings us to the main thing, that how is the total income to be computed under NTR? Now, as one sees the law is very clear that the law starts with a non-obstant clause, as we call it, nothing contained anything to the contrary, and subject to provisions of this chapter. So that is something which we will deal later. But for this moment, one has to bear in mind that the non-obstant clause, which gives the overriding effect, is qua the rate of tax subject to other provisions of this chapter. And therefore, if one sees where 115 BAC chapter is there, in the same chapter, which is chapter 12, one will find there are special rates so far as, let's say, short-term capital gain and long-term capital gain. If you income from patent, if you income from BDA, if let's say I got income from 60 undisclosed income, so then the tax rate will be 60. Now also falls within this chapter is section 115A. So when we analyze this section, one has to bear in mind that insofar as the general rates of taxes are concerned, excluding those specified under chapter 12, then that stands substituted or stands overridden and will be as per 115 BAC 1A. So that is one thing. Now, once you do that, the second question is, what are the exemptions and deduction? How do I compute my income? So my income, which is computable, will be without any exemptions or deduction listed. We will come to that clause under clause 1. Without set off of certain losses attributable to expenditure or deductions listed in clause 1. Without the set off of loss under that house property against any other head, without with normal depreciation, excluding additional depreciation, and without any other allowance of perquisite under any other law for time in force. So that is a mechanism in which now your total income will be computed. You will forego some things, you will be denied some losses, some depreciation, and then your total income will be computed. So as we said, I have made this table just as a reference. It may not be an exhaustive list. So what are the exemptions and deductions which are not allowed? And I have just said, if you say under the head salary, now as we all know, as a salaried person, we have a leave travel allowance, which is exempt in a block under section 10(5) for 2 times. Most important things for most salaried people is the house rent allowance under section 1039, which at times is quite significant and which may be very relevant factor when one evaluates as to whether I should choose between the old tax regime and between the new tax regime. Then there are certain allowances, as we all know, under section 1014 with rule 2BB, let's say helper allowance, a uniform allowance, etc. So that will not be allowed now. Now here we will come to some exceptions later. Then some other allowances which normally in day-to-day business we may not be concerned, like member of parliament, etc. And insofar as meal vouchers are concerned, which is an allowance under rule 3. Now there what has happened is that under NTR 1, they have carved out a proviso to say that 50 rupees per meal, which we normally have for salaried class, will not be allowable. As of today, as we speak, the rules to that extent have not been amended to say that even for NTR 2, it will not be allowable. Insofar as the transport allowance is concerned, or the conveyance allowance, or the cost on tour of travel is concerned, now these are again specified under 1014. And though generally the allowances were not exempt under 1014, when NTR 1 was introduced, they modified the rules and they said that, okay, insofar as these 3 allowances are concerned, you will continue to have them. Now, as of today, again, this may be subject to the final changes in the rules or notification. So that is one. Now, the difference between NTR 1 and 2 was also that now, like the old tax regime, the NTR 2 will also allow you a standard deduction of rupees 50,000. So that is a major change insofar as salary is concerned. Insofar as house property is concerned, friends, I don't think there is any significant change between NTR 1 and 2. Suffice to say that generally the interest which you pay on a self-occupied property, the ALV of which is computed under section 23(2) will not be allowed to you. So to that extent, you will not get, when you compute income from house property, let's say if I have paid an interest, and we'll come through case studies and later questions as well, but that may not be allowed to you. There is no bar insofar as per se deduction of interest under 24B insofar as let out property is concerned. Income from other sources, the main impact has been that under NTR 1, there was no deduction of family pension, though very small in some. I mean, you can claim exemption only up to 15,000. So that is now allowed under the NTR 2. Clubbing is not allowed under NTR 1 and 2. Insofar as business and profession is concerned, friends, 10AA is not allowed. Additional depreciation. So I would just pause and harp on this slide. So here what I want to say is really that when one evaluates between old and new tax regime, one will have to really look at the income computation under different heads and then see like what we have done and what is allowed. So insofar as if anyone is having a business income is concerned, really speaking, what are the deductions which will now not be allowed to him? So I would feel that in a normal course of a day-to-day practice or a normal individual business and he's having an additional depreciation or execution, this is really something which is not be allowed depreciation, and therefore ultimately in my view it is, which also is not relevant for all of us, but when you see that rates of depreciation now, generally now in our act, if one sees the rate of depreciation, it is restricted to majorly to 40%. There is only one entry. It is, I think, for people engaged in the leasing of motor car, etc., that 45% was there. And where under NTR 1, they said that, sorry, in that case also, it will be restricted to 40. And like what we read for the meal vouchers or, for the 3 allowances, this also may be tweaked in the rules in the coming days. And under chapter 6, generally, as I said, we don't get any deduction under chapter 6 under NTR 2. However, additional employee 80JJAA, then employees contribution to NPS, and the famous Agniveer scheme which the government has floated. So if one gives contribution to these three, then you still get a chapter 6A deduction for these three sections insofar as NTR 2. Now, the next question, friends, which we will answer is that whether carry forward and set off of losses are not permitted under NTR. So, as we said, one of the item was that set off of a loss or a loss or depreciation as a result of certain deductions under the earlier clause will not be allowed, and separately the set off of the loss from house property with other heads of income will not be allowed. So therefore, it is not that all losses, I mean, when one say the new tax regime, your entire losses which was available to individuals from capital gain, as per normal provision, will be allowed to be if there are any losses, it will be allowed to be set off generally. There is no bar in the set off and carry forward of losses from capital gain. There is no bar, friends, of losses and set off of income from business. There is no bar of set off of losses under the head other sources during the current year against other head of income. Therefore, really, when one evaluates these clauses, one will have to really evaluate house property is something which we will address in detail, which is impacting a lot of people. And second is that, okay, if your losses had arisen on account of additional depreciation, on account of certain scientific deduction, on account of 32AB, so because of any of those reasons you had losses generated, then now we are given to told that, sorry, that would not be allowed. And further, we are given to understand that those losses which are not allowed under that particular section, that is 2, would also be deemed to have been given full effect to. Now, what are the implications of this? We will study in the subsequent slide, and we shall also see the case law on the same. And while we are on that aspect, so while we are on this question, I would also probably address something which we will understand when we take the case study. But since we are on losses and carry forward, I'll make certain points insofar as income from house property is concerned. So friends, we all understand that, as I explained, that under the head income from house property, we may have self-occupied property, we may have let-out property, we may have deemed let-out property. Now, what the new sections or NTR 2 bars is that you cannot get a deduction of interest under interest attributable to SOP. Now, either is under section 24B. We all know that the interest which is otherwise also allowable is only up to 2 lakh rupees. So now we are given to say that if I have an income from self-occupied property and I have got interest which I pay to a bank, then ordinarily I would under the old taxation get a deduction of the 2 lakh rupees. Now this is not allowed. So in that event, there would not be any loss itself generated under SOP. So that is the first point. Now, connected question to this, which may come up, friends, is that, okay, what happens to section 48? So as we all are aware, in the budget, what has also happened in last budgets, in fact, is that today there was some controversy as to what people used to do. People used to claim the deductions under section 24B and also section 48. And then they amended section 48 to say that if you already claimed a deduction under any other provision, you will not get it. Now, therefore, the question is really that now that I don't get the interest on SOP, can one say that I can add it to the cost? That is a consequential question, that if I'm not getting now any deduction itself while computing income from SOP, then what happens? Now the point is that there are two things. One, there are case laws which will come to, where there are courts which have taken the view that under general accounting principles, as to whether interest can be capitalized pre-acquisition, which we all know and which we can do accounting in accounting. But there are some case laws which we will refer to in the subsequent slides, where they say that even if it's a post-acquisition interest, one can capitalize. Now, in my mind, it's a debatable issue. There are Supreme Court, there are High Court judgments. So one will have to take a call, disclose, and do the needful. But the main question which I would share, and these views are purely personal, is that once you don't get a deduction under SOP, and it is deemed to have been allowed, deemed to have been given effect to, can really one say, no, therefore I can still add it to 48. So in my mind, it becomes very difficult, deemed to given full effect to. However, if someone takes up with that, look, I never claimed anything under 24B as SOP, and I was directly capitalizing, then there may be some dispute if you directly take it under 48, insofar as post capitalization is concerned. But as I said, one will have to view certain judgments on pre and post capitalization, and then take a call on SOP. Now, insofar as deemed let out or let out property is concerned, friends, what would happen is that there is no bar on interest on those property, and therefore it's quite possible for an assessee to say that, look, I have paid higher interest as compared to the let out value insofar as let out property is concerned, annual letting value, and there is a resultant loss. Now, as we said, so therefore there is a loss under LOP. Under SOP, ALV is nil, no interest, nothing. So now the question is that if there is a loss, and then what is the effect of the provisions? So the provision only says that to the extent you are allowed to set off the loss under that house property against other heads, that also will not be allowed to you and would be deemed to have given effect to. We will come to that in case studies and later slide, as to really, is there an issue on the amount of what is deemed to have been given effect to. Now, this is, friends, very important, that as I said, that under NTR 1, it was an opt-in provision. Under NTR 2, it is a default tax regime, and therefore it is an opt-out provision. And what is a procedure? So the procedure, friends, is listed under 115 BAC 5 insofar as NTR 1 is concerned, and 6 insofar as NTR 2 is concerned. And basically, the distinction is made considering that whether an assessee has income under the head business and profession or not. If there is an income from business and profession, then I should exercise the opt-out option under default tax regime on or before the due date of furnishing the return under 139(1). Secondly, once I exercise that opt-out option under NTR 2, that if I have business income opting out and I file the declaration within the stipulated period, then for all subsequent year, I have opted out, and therefore I would always be under the old tax regime. So that is one. There is option that once you can withdraw that opt-out what you exercise, and thereafter it will only be permissible only if you cease to have income from business. Insofar as those category of assessees are concerned, friends, which do not have income from business and profession, then in that you need to again file a declaration, a notified form, which they would notify for NTR 2, along with the return under section 139(1), and that is an annual option. So every year when you do, along with your ROI, you'll have to do it. This, friends, also has certain issues on the dates, etc., coupled with the fact that whether a belated return will be considered as 139(1), and we will try and cover it later, either as a case study or a separate question. So as I just said, so I think before we come to case studies, in my slides I have captured certain controversies which may come up. So, friends, as we said, the law, if one sees carefully, between the two clauses 1 and 2 of 115 BAC 6 has made two distinctions. One, insofar as income from business is concerned, it uses the word on or before, and importantly, on or before the due date. So let's bear in mind the three words on or before, and also the due date specified under 139(1). So that is one. And secondly, as we said, along with the return under to be furnished under 139(1). So friends, there is a distinction in the language, and therefore one will have to apply the mind as to it cannot be the same. Now, one question which may arise is this, that as we all are aware, let's take an example that, as an individual, my return filing date is say 31st July. Now, under the present provision to my mind, under 139(4), I can file a belated return up to 31st December. Now, the question is this, that let's say that a person, can the option be exercised in both these scenarios? Okay. By the time I file the belated return. Now, we will understand that is in more detail when we take the case study. But here, friends, the two case laws which I have cited are relevant. So, one case law says that, look, 139(4) is not an independent provision, but it really goes back to 139(1). And therefore, in the Punjab and Haryana High Court took a view that even if some claim was made, which was required to be made by 139(1), but it is made in the belated return, it will still be valid. Now, completely different view has been taken by the Calcutta High Court, where it takes a view that, look, if the reference is to due date under 139(1), then you cannot be allowed a claim by just filing a belated state at a later date. So this is a facet which one have to bear in mind, friends, that 139(1) due date mentioned, 139(1) no due date mentioned, just said furnishing of return under 139(1), and what is the impact of 139(4). And we will cover that in the case study. Also, friends, is one important thing which one has to bear in mind in light of a recent Supreme Court judgment in Wipro is that so while Wipro was considering a revised return case and not a belated return, and there also there was some 10B claim to be withdrawn, and under 10B(8), the stipulation was that yes, you should file a declaration for withdrawal before your AO on or before the due date of filing 139(1). Now, in that context and on that particular facts, because I mean, I would not want to go into that case law right now, which itself is a subject matter of a lot of debate amongst professionals. But in that context, Supreme Court held that the declaration under 10B to opt out is a declaration in terms of filing and timeline, which is both mandatory to be done and not directory. So generally, friends, in law, we all professional knows, I mean, whoever are attending this, that whenever we have to file something under some certain sections, the general position in law was that while the filing was mandatory, the timeline, even if it's written 139(1), was directory, and therefore there were case laws which took a view that even if you file that, even if you file after the due date of 139(1), but during the course of assessment, in some cases, even in appellate procedure, the courts had taken the view that it is a directory requirement and therefore permissible. Now, in light of the observation of Wipro, one will have to distinguish Wipro and take a call, and therefore one will have to always err on the side of conservative view and try to file everything within time. So, as I said, while Wipro takes this view in this slide, there are this case laws which take a view that no, it could. Now, another question which comes up is that can an eligible person NTR 2 and OTR for different? Now we are talking of NTR 2, and therefore we are talking of the default tax regime, and therefore one will have to really answer this question based on whether your business income. In business income, once you exercise the option of opt out, you are deemed to have opted out for all future years, and therefore generally you are under old tax regime, and thereafter once withdrawal is permissible as is spoke. Insofar as individuals are concerned which are not having, or I mean, other assessees are concerned which are not having, income from business, as assessee, I can choose every year, depending upon the working which I make, depending upon the income which I have, depending upon the exemption. In 1 year, I may think of, opting out and following the old tax regime. And in 1 year, I may say that no, I don't want to opt out, and therefore I'll continue the default tax regime. Now, friends, that takes us to question number 13, which is quite important. I mean, from a conceptual perspective, is that what are the consequences if I fail to compute the total income as permissible? As we said, total income has to be computed without certain deduction like 10, 5, HRA, interest. It has to be computed without giving effect to certain losses, set off, etc. And it has, so if that happens, if I don't comply that, then what happens? Now, friends, this is very important. So here what happens if one sees the proviso also to 115 BSE 1. Now, please bear in mind, friends, that this is for only the new tax regime 1.0, which, as we have understood so far, is a opt-in provision. And therefore, what happens if I don't compute as per the stipulated formula under new tax regime 1, then automatically OTR will apply. That is, the old tax regime will apply. However, friends, now we have to bear in mind that NTR 2 is a default tax regime. So even if I don't compute my income under NTR 2, or let's say if I make a mistake under, let's say for example that I cannot claim HRA, but I've claimed HRA and I've not opted out. So therefore by default I've opted in. Now in such scenario, what would happen? So in such scenario, friends, my personal view is that because it's a default tax regime, in my view, there is no other option to go to OTR 1. And in your assessment, in your intimations, in your reassessment, if someone finds out that, look, you wrongly computed, they would recompute as per NTR 2 and ask you to pay the differential tax. So that is important. So therefore, the answer is that if one even by mistake does not compute income in accordance with NTR 2, then also you will not get a right by default to say that, okay, since I made a mistake, please consider OTR. Now, this is an important question, friends, which a lot of professionals may be interested in. So the question is, friends, that is the presumptive tax also available in NTR 2? Now, as we all are aware, friends, there are few sections under section 44 AD, etc., where there is a presumptive tax. Now, for common understanding, to just take an example, if let's say I'm a professional, if my gross receipts is not exceeding 75 lakhs, then under 44 ADA section, I have an option to go for the presumptive tax, and where it would mean that 50% of my receipts will be deemed to be the income. Now, that is what the section says. Now, as we said, the NTR 2 is a default tax regime, and insofar as NTR 2 is concerned, it is a tax rate which will be governed by the new slab rate, and therefore, in my mind, since that overrides only the income tax payable, in my mind, it is quite possible that even a person who has opted for the presumptive tax regime can still get the benefit insofar as 115 BSE is concerned. And therefore, it may be a welcome benefit to someone who is a professional who may evaluate that, look, let me be in a default regime. Obviously, friends, before we conclude any such things, we have to see that even a person who is in a default tax regime, whether he has got enough chapter 6A or other deduction. I mean, in presumptive tax regime, what will happen is that unless you have significant chapter 6A deduction, in my mind, presumptive read with 115 BSE 2 will be beneficial. Now, next question, friends, is that what will be the tax rate applicable on capital gains under NTR? So, friends, as we said, this section begins with notwithstanding anything contained to the contrary, but subject to the provision of chapter 12, since short-term capital gain in the 111A, long-term under 112, 112A are all falling within chapter 12. Therefore, to that extent, the rate specified under 111A, 112 and 112A will apply. That takes us to the next question, friends. That is the new tax regime applicable to a non-resident? I don't think there is any bar, and therefore prima facie, and in my view personally, it would be applicable even to a non-resident. And EOB to the extent it may apply. Sorry, 150A also apply in case of non-resident. So again, like long-term and short-term, which we referred in question number 15, friends, even this section falls within the same chapter 12, and therefore the rates under 115A will override the rates provided under 115 BAC. And as you all are aware, most rates under 115A are gross based taxation. Now, this takes us to the next question, friends, which is very important. That can a non-resident claim treaty benefit under new tax regime? Now, why this question is relevant is only because of the, I don't think, with the language which 115 BAC 1A starts. So maybe I'm repeating, but as we are aware, it starts with a non-obstant clause. Nothing contained contrary in the provision of the act, or nothing contained. Now, the point is that section 92 is not under chapter 12. Now, if one plainly reads 115A, which is notwithstanding anything contained in this act, can one take such a view that, look, because the plain language of section is nothing contained, notwithstanding anything contained in the act, I'm sorry, can one take a view that because 92 does not start with a non-obstant clause, and therefore, insofar as rate is concerned, a non-resident will be governed by the rates and by a default tax regime unless you opted out. So therefore, can one take a view that if I'm an individual, a non-resident who is a citizen or a resident of some other country, and if the rate under my treaty with India is more beneficial, then can one say, okay, sorry, I will deny you that rate because now you have failed to opt it out. You are on a default tax regime. Now, as we all know, friends, a tax treaty is entered into after a lot of negotiation and basically divides the taxing right between the state of source and state of resident. And as we all are aware, in a lot of treaties which India has executed, the rate of tax, specifically insofar as interest, royalties, in some cases FTS, may be lower as compared to the rate under 115A. And therefore, it is quite possible that a non-resident may say that, look, I want to be governed by the treaty. Now, in my view, personally, I don't think there is any, while the language I understand is saying notwithstanding anything contained in the act, but in my view, if one goes back in history and starts with judgment of Visakhapatnam Port Trust, followed by Azadi, followed by the observation of engineering analysis, etc., in my view, it's very clear that section 92 will still override insofar as 115 BSE 1A is concerned. And therefore, in my view, the non-resident ought to be given the treaty benefit. And to that extent, he would be in path with the old tax regime. That is my view. And also, friends, one has to note that, I mean, I know that it's quite simple, but just a thought that if one sees section 92A, so if one says that, when department wanted, or when when department or the government wanted that, look, even if the treaty is beneficial, but if one invokes GAR, then that rate will not apply to them. So something of that sort is not presently mentioned in anywhere under 115 BSE 1A. And therefore, on a holistic basis, considering this circular on question 18, Vienna Convention, important is also the Article 51(1)(c) of the Constitution, which says that the state shall endeavor its best and to respect the international law, as also taking some ratio from the judgment of Bank of Tokyo, which was upheld by Delhi High Court, in whereas, friends, we know that under 115 JB also it starts with non-obstant clause. The court took up with that, look, even if it starts with a non-obstant clause, 92, that is a treaty, will have overriding effect, even under 115 JB. And therefore, to sum up, In my view, one should get the treaty benefit, and I would only be happy if the department also, like what we have attempted here, come out with an FAQ for the NTR2, or at least clarifies, so that if at all anyone has a doubt, it may come to rest. Now, with that, we come to question number 19, friends. Rebate under 87A. I had explained this when I began my session, that yes, the rebate limit has also increased up to 7 lakhs if a person is in a default tax regime. Next question is, friends, that as now we understand that individual it may not even. Am I audible? Because Abhidan, was I audible? Because I'm.
Yeah, you're audible, Ronak.
Okay, okay, fine. And my screen is visible now because I think I dropped in between. Chirag, is my screen visible?
Yes, yes, it's visible.
Okay, okay, thanks. Sorry. Yeah. So, friends, we were on question number 21. I think, yes, there is some benefit because department is encouraging and government wants to encourage IFSC, and therefore you will continue to get the benefit of deduction if you have a unit in IFSC. Now that takes us to the next question, friends, which is quite important and relevant also. So the fact is, friends, that as we are aware, under NTR 1, the new tax regime 1 was applicable only to individuals and HUF. And there is always a question as to whether even a trust, let's say a private discretionary trust is what we are talking, is the individual or not, and therefore whether it was already covered under NTR 1. If it was covered, there is no doubt. But now, in fact, it is more relevant because now even if it's deemed to be an AOP or treated as an AOP, it would be covered under new tax regime. So really the question would come to as to what is the status of a trust. It is an individual, it is a AOP, BOI or artificial resident person. Now, friends, there are case laws directly, so I will not go into that. It's clearly a private trust which is set up, which is very common in India. It's not a BOI or an artificial resident person. Now, the question is also that whether the trust is an individual or an AOP. In my mind, the case laws are quite clear, and for the sake of time, I would not refer to the case laws. Suffice to say that it's mentioned in my PPT, and I will share it later. But I think the main distinction between AOP and private trust is this: that for associate person, one needs to, persons need to come together for a common purpose, and that is when an AOP generally is formed. When one sees the judgment of Indira Balakrishna or Marks and Beneficiary Trust or Shriram Ownership Trust, etc. Now, when a private trust is set up by a settler, the beneficiaries and trustees don't come together to earn an income or for a common purpose. And therefore, to my mind, private trust would generally not be an AOP. So therefore, that is one. Then the question is that how do I determine the status of the trust? Depending upon the beneficiary, depending upon whether it's determinate or indeterminate. So, yeah. So friends, as I said, now in 2012, a CBDT in the context of certain dispensation, where people start first time electronic returns were required to be filed. They had just clarified that even if it's a private discretionary trust, and for the context and for everyone here, in very simple terms, a discretionary trust is something where there are beneficiaries, but the share of the beneficiary is not determinate. It depends upon the discretion. and a determinate or a specific trust is something where the share of beneficiaries are determinate. So everyone who's a beneficiary knows that whether I'm 20%, 30%, 50% beneficial owner of the trust property and the income. So in 2012, they said that look, when they wanted to dispense for the purpose of e-filing, they said that even a private discretionary trust is an individual. However, I just saw the instruction for AY 20 to 23, and there, surprisingly, without any distinction as to who are the beneficiaries, they are saying that look, any private discretionary trust should also, if it's not filing return under ITR 7, which applies to charitable trust generally, will have to file ITR 5. So I think that's not correct, frankly speaking, and we will come to it in a bit. So as I said, friends, that this is a general taxability of a determinate trust and a discretionary trust. I would not want to waste time on that because, as I said, the slide is there. But this is what is important, friends, that insofar as if it's a determinate trust which is governed by section 161(1), then the section is clear, the law is clear that each trustee will be assessable in the same action and like manner as that of beneficiary. So in case of a determinate trust, there may be as many assessment made in the hands of the trustee as are the beneficiary, because it is same action and like manner. Now, therefore, the question is that in such cases, who opts in, who opts out, etc. Now, in my mind, let's say that if all the beneficiaries are individual, then one will have to take a stand that the status of the trust is individual. And if it's a determinate trust, in my mind, even if the trust files a return, it is better that the beneficiaries who are there, the individuals one, they also file their return, include the income and specifically opt out if they want to opt out. So that is insofar as a determinate trust is concerned. Now, question is that if all the beneficiaries are companies, now in my mind, then the status would not be of individuals, and it would be probably the status of a company, and therefore prima facie 115 BSE will not apply. Now, what is what if some of the beneficiaries are individual and some beneficiaries are corporates? Now, in such case, friends, I don't think I have any direct answer, but I would feel that in such cases, when it's a case of a discretionary trust, when the shares of beneficiary are not known and the beneficiary comprises of both individual and company, one can take a call based on certain judicial pronouncements that it is nothing but a status of an individual. So that is something I think, but which is also presently a gray area as to status of a discretionary trust when the beneficiaries are both. Now, will NTR to apply to a charitable trust? So I would feel that except Section 8 company, it should generally apply to charitable trust. So it per se will apply to charitable trust if it is any taxable income, but specific provision of charitable trust will also apply. Now, I think here I would again not repeat myself because I think we are running out of time and I have to take the case studies and questions as well. Yeah. Then the next question, friends, is for those people who are salaried. I think the question is that how does the employer determine and discharge 192? I think the board in a welcome circular has said that the general presumption would be that yes, the employees will follow NTR 2. Obviously, they can there would be an intimation from the employee to employer, and based on that, the employer can take a call. It's also clarified that that insofar as the individual employee is concerned, that intimation will not be akin to the declaration as required under the section, and therefore the individual, if he decides to opt out and he indicates that also in the intimation, while the TDS will be under the old tax regime, but he will have to ensure that he also files the declaration within the permissible time and the manner as prescribed. So now, friends, with this basic question answers, we will come through one chart which takes us to the break-even point. We will devote 2 minutes on that, and then I will take the case studies. So friends, yeah. So friends, this is a chart I'm sure you would have seen in a lot of newspapers and lot of articles. But for benefit of everyone who's attending this session, so really what I've tried to show is that what is a break-even analysis. I mean, if I want to really see that at what point, whether under the old and the new tax regime, the tax will be same. So here what I've done is, if we see the column on your screen, we have stated if the total income is from 5 lakh to 5 crores, and on the top we have said if the deductions, so I would put it, one may call it deduction, exemptions, etc., whatever is not permissible under new and otherwise permissible under old. So if you claim a deduction of 1 lakh rupees, then if your income is up to 6 lakhs, then under both regime you are same. If your deduction was under 1 lakh only, then your income is 7 lakhs, then you are better under new tax regime. And that is how one comes to the final figure on the right, that if you are under old tax regime and you are claiming deductions up to 3,75,000 and your income is up to 12 lakhs, then under old regime it is beneficial. If your income is higher, then as long as you are claiming 375, then, and if your income is higher also, then per se it would not make a difference. For this purpose, I have not taken the surcharge under the old tax regime, which is at the highest income 37% and not restricted to 25. So now let's friends take certain case studies. So let's say that I have taken an example of a salaried person, and very quickly I will go through the case studies. So Mr. Ram is a 62 years old executive. So under old tax regime, he would be a senior citizen. I have given what is his breakup of salary, other sources and deduction. So important to notice that his salary is huge, 6 crore 50, but he has HRA which is of 75 lakhs, which is significant. He has a contribution to NPS by his employer, which is permissible, which is 14 lakh 50,000. He has certain helper allowance 360, which is allowable under old tax regime. Conveyance allowance, he has got a car perquisite which would remain the same. Insofar as income from other sources is concerned, he's got interest from deposits of 130. He's in receipt of certain family pension of 125, and there is an interest on PPF. And what are the deductions which Mr. A is claiming? So he's claiming PPF of 50,000, NPS of 1450, that is his own contribution. Then Mediclaim of 50,000, and for sake of proper comparison, we have said that 80 triple EE, if I'm not wrong, which is the interest allowable for electronic vehicle up to 1 lakh 50. So he's paying 2 lakhs as interest on that, and let's say he's eligible for certain ATG deduction of donation, and he wants to evaluate as to whether he's better off under the old regime or new tax regime. So friends, I have computed in the table. So let's quickly go through the old tax regime. So under old and new, you start with gross salary. Perquisite have to be added back based on the driver and the car cubic capacity. Then employer's contribution will be added back. Then perquisite, insofar as contribution in excess of 7.5 lakhs again. And then perquisite on interest on such excess contribution. Now, important is what I've highlighted. Under old tax regime, I will get a leave travel allowance of, I presume, 2 lakh rupees. I will get an HR of 75 lakhs, which is quite significant. Again, conveyance allowance, friends, I have assumed that like for NTR1, there will be a notification which allows under NTR2 as well. Helper allowance, friend, does not fall within the permissible allowable allowances under NTR1 and 2, and therefore it will only be allowed under old tax regime. Now we get standard deduction in both. In NTR, we don't get the professional tax, and therefore my income from salary is computed at 5.89 and 6.69. Insofar as income from other sources is concerned, friends, now I get family pension 1/5 up to 15, 1/3 up to 15,000 a deduction. So I reduce that, and my income comes to 240. Now this is what is important, friends, which one will have to evaluate in a day-to-day practice. So under old tax regime, under 80D, we are aware we get 50,000. Under 80EB, I mentioned 80EA earlier, but it is 80EB. So I get interest up to 1.5 lakh on my loan taken for my EB. Then I get a donation deduction. Then, as friends, we are aware that to senior citizens, there is a 50,000 deduction for the interest on FDs which I get. Then I have said that cumulative 1,50,000 is what I get under ATCCD. Incremental 50,000 under ACCD 1B, and under both I get the employer's contribution to NPS. So after we compute the total deduction, my net income comes to 6 crore 11 and 686. And if we apply the higher surcharge, etc., then the old tax regime is more beneficial. So friends, as we saw here, the deductions were much higher, and therefore the old tax regime would still be more beneficial as compared to the new tax regime. Now, friends, this example is to understand the issues around income from house property, interest, and loss set off against other head. So we are given to we are given the fact pattern that Mr. Mohit is aged 45. He's got a salary income 1.5 crores. He is having two houses. H1 is a self-occupied. H2 is a let-out property where I'm getting 4.5 lakh rent. Both were presumably acquired from borrowed fund. The loans are outstanding. Apart from H1 and H2, Mr. Mohit is also now acquiring from borrowed capital a third house, which will now be deemed let out. And let's say that for the first year, the notional ALV is 1,50,000. And this is something which is a fact pattern that the previous, before this year, the carry forward SOP losses are 4 lakh. And now Mr. Mohit has to evaluate under NTR and OTR. So friends, let's first see on the right side of your screen. So we are saying for H1, that is SOP, my annual ALV is nil. 30% obviously is nil. Interest on borrowed capital, let's say I actually paid 5,20,000. I would have been allowed 2 lakhs under the old tax regime, and therefore I would have a net so I would have a net loss of only 2 lakh rupees, because beyond that it is not allowable even under 24B. Insofar as the second property is concerned, friends, which is 4,50,000. Again, in similar manner, we have said that 135 is your 30%. 2 lakh was the interest on borrowed capital. Allowed 2 lakh. Again, there was a positive income. And in last case, since the interest is higher, there is a loss. Now, now if one sees the computation old tax regime, I start with salary because we are considering a house property. Let's say under old tax regime, my loss from SOB would have been 2 lakh rupees. My gain from LOP is 115, and my loss from DLOP is minus 445. So the net loss from income from house property is minus 5,30,000. So under the head house property for the current year, my net loss is 530. My positive salary income is 150. Now, as per 71(3)(a), the loss under that house property only to the extent of 2 lakhs is allowed to be set off against the other head. So I will set off 2 lakhs loss, and therefore my gross total income will be 1,48,000, and the carry forward loss will be 330 and 4 lakh under the old tax regime. Now, friends, this is important. When I come to new tax regime, as we said, while computing income from SOP itself, I am not getting interest as a deductible expenditure. So the question of that will not arise at all. The ALP, the income from SOP will be just nil. However, insofar as the other two losses are concerned, yes, I will have a net loss of 330. Now, friends, here the important question is really this, and this is some controversy which I wanted to highlight. When the section uses the word that, and I'm just reading the section, the loss and the depreciation referred to in so and so clause shall be deemed to have been given full effect to, and no further deduction shall be allowed for any subsequent year. Now the question, sir, friends, is this: I have a loss of 330. Now you are saying that any loss under the head income from house property with other heads of income will not be allowed to be set off. So I could have set off in law only 2 lakhs. And therefore, if one gives meaning to the section which says a deemed full effect is given, the question is whether one will say, no, 330 is what you are allowed to set off, and maybe you are allowed only 2 lakhs, but entire entire thing has lapsed, and therefore it is the carry forward is 0. Or will one take a view that, look, I was even otherwise allowed to set off only up to 2 lakhs, and therefore 1,30,000 is something which I will be allowed to carry forward. So that is the question in my mind. When the law says that you will not be allowed set off of income from house property against other sources, and that would be deemed to have been given effect to, I would probably interpret it to mean that which is otherwise allowed to set off, and therefore up to 2 lakhs. And therefore, in my mind, 130 should survive, but it may lead to a controversy. As we discussed this when I dealt with income from house property, that just case law's reference for everyone's sake as to whether pre-capitalization, post-capitalization interest allowed, not allowed, while Supreme Court in Chellapalli says that commercial accounting principle would have to be adhered to, and that would generally, in my mind, say that anything post-acquisition cannot be cannot be capitalized. But we have the judgment of Maitri Pai, which somehow has an observation that pre and post does not make a difference as long as you don't claim other deduction. So one will have to really see in a holistic manner, and while computing income from house property on a practical case-to-case basis, one will have to really bear in mind that SOP nothing will be allowed on a new tax regime. If I've got letter property, or if I've got deemed letter property, in that event I will have to really, again, if I want to go correctly as per law without any dispute, I may still be choosing to capitalize my pre-capitalized interest, which exceeds 2 lakhs, depending upon my DLOP and what is the imputable loss, which would have been deemed to have been allowed. Now, next example, friends, we will just take to give effect to another provisions of 115 BAC, the new tax regime, is that the section says that whatever was the opening depreciation to the extent of a non-permittable deduction, I would be allowed to increase my block. So to take an example, we are given a fact pattern where in assessment year 23-24, Mr. Shyam has opted for the NTR, that is a new tax regime, and which again does not allow additional depreciation friends. So his profit is 50 lakhs. His opening WDV as on 1/4/22 is 750. Normal depreciation carry forward is 125. Additional depreciation of earlier year, which is not set off, is 375. And in second year, his income is 65 lakhs. Second year, he proposes to acquire another plant and machinery. So, friends, again, here I would first invite everyone's attention to the right-hand side of the screen. So, if we see how the depreciation will work, so we are saying that 750 was my opening WDV. Now, what is barred? And as I said, it will only be a timing difference, is your additional depreciation claim. So, whatever is your additional depreciation is unabsorbed, I will add back to my block of 750, and thereafter, what is normally permissible at 15% will be allowed to me, and therefore the depreciation, the closing WDV will 956. In next year, 956, I will add the new machinery compute, and on left hand side, I've just given the working. And as friends, we all are aware that the normal depreciation, which is not relatable to any items above or additional depreciation, is allowable to all assessees, subject to a 40% cap in the schedule. Friends, this takes us to the next case study. Mr. Anand wants to determine whether he should opt out of NTR in AY 24-25. So, friends, here income from house property is 16 lakhs, profits and gain from business and profession is 10 lakhs, long-term capital gain on sale of flats is 23 lakhs. Now, friends, the brought forward losses and unabsorbed depreciation. So, friend, he is deciding, so he's by default under new tax regime, and he wants to decide whether he should opt out. Why? Because he's got carry forward losses on account of SOP, on account of LOP. Then he has got certain business loss which is not attributable, so it's a normal business loss, he has certain business loss which is attributable to 35(1)(2), which is now not allowed, and he has unabsorbed depreciation on account of additional normal depreciation, long-term capital loss. So friends, now if we see under the old tax regime, I will first come to my GTI. Now, as we said, under old tax regime, I will get the set of under that house property, I'll get a set of the current year's loss, whether it's on SOP or it is on LOP. So I get that as a deduction. In fact, business loss also I fully get it, whether it is relatable to 35(1)(2) or not. So all deductions virtually I get it, and ultimately my net taxable income is 37 lakhs, and my tax liability, which is applicable for LTCG at 20 and other than 20 at slab rates, will come to 780. Now, as compared to that, this point is just to bring home that SOP loss will not be allowed to be set off. Again, business loss, which is relatable to any of the any of the non-permissible items like 35(1)(2) will not be allowed. Similarly, additional depreciation will not be allowed, and therefore the tax liability and new tax regime will be higher. Friends, I think in the interest of time, I would skip this case law because I've already dealt with the controversy as to whether a non-resident should be eligible for the treaty rates or not. My personal view is that he should be eligible, and therefore, his computation may be in a so therefore, maybe under old tax regime and under new tax regime, if in both case for rates of tax, he can go to the treaty. I don't think there should be any controversy. So I'll just skip it for the time being. Yeah. Now this is something, friends, now which is important, and I think now we are left with 2 or 3 case studies only, so that we have time for some Q&A. So friends, here again, before we start this case study, the case studies are now pertaining to 2 things. What is a switch out provision? What is beneficial when you can switch out, when you can switch out only one time, etc. So let's say that Mrs. Anisha is a lawyer. She is earning a professional fee. She has income from other sources, and she has also a Chapter 6A deduction. Now, she is right now considering as to whether she should opt out of the new tax regime 2.0. So by default, she is having income from, amongst other income from business. She is considering the position for AY 24-25, and therefore to decide as to what to do. Now let us, so as we read, friends, that under the new tax regime 2.0, 115 BSC 6.1, if I have a business and if I opt out, then I will be in the old tax regime, and I would continue to remain in old tax regime in the future years. So 24-25 OTR, 25-26 OTR, and now 26-27 she excites and says that okay. So now the question is that can Anisha again opt out from NTR 2 in future years, assuming that she continues to earn professional income? So friends, here what has happened that once under 115 BAC 6, she has decided to withdraw from the opt out, and thereafter she would, so therefore by default she'll be in opt in, and thereafter she would not be permitted to opt out again unless she ceases to have business or professional income. So that is the point we wanted to draw in here. Now let's continue a case study, which is typical. That let's say after a few years, I mean from so now let's say that we have taken a position that by default she cannot opt out and she is in opt-in. And now, however, she is now restructuring arrangement with a firm, and the firm now decides to pay salary instead of income from business or profession. So friends, now if she's getting, so now she does not have any income from business or profession. She ceases to have income from business or profession, and therefore in my mind, in my view, though she is now otherwise opted in, because now she ceases to have income from business profession, she will have annually an option of choosing to opt out or not. So that is the first answer to my mind. Now, this is the second question, friends, is something which even I have no finite answer, but I'll try to address what I can. So the law is silent. What happens to one when, let's say, I had a business income in some year. For a few years, I had got business income. Then the business income ceases to be there. And therefore, I have an option of annual opt out. Now, let's say again after a few years for the same assessee, she starts generating business income. Then what happens? In my view, I think this is quite common for people, and therefore I don't think she should be denied to say that, look, once you cease to have a business income and you had salary, you had an option of opting in, opted out. Now once more you got business income, and therefore according to me she would still have a choice. The year she starts generating business income, again she will have to read 115 BAC 6 and decide. So, and if thereafter, if she, let's say in 2020 she has a business income, and if she decides to opt out, then for all times of future years from that, until the time again she ceases to have option, she would have been opted out. Then this is just a very simple example, only to bring home this point that Mr. Mohit is a partner. He's only getting share of profit, which you all know are aware, which we all know is exempt under section 10(2)(a), and therefore he has no income from business in the total income. He has just income from other sources. I think the question is very clear that because he does not have income from business, he will have every year opt-in, opt-out option. That takes us to the that takes us to the last two case studies. And I will just try to complete it and by 6:30 so that we have some time for Q&A. So friends, this case study again is all the controversy relating to the due date on, along with etc. So let's say Ms. Neha has an income from business profession for FY 23-24, AY 24-25. So she is under default tax regime 2. Now the due date to file return, let's say she's an individual, is July 31st, 2024. Now the question is, what are the scenarios and what would happen? So let's say in scenario 1, she decides she has an income from business and she decides to opt out on July 1st, 2024. Now friends, what is the language? In case you have income from business, you should exercise the opt-out option on or before the due date specified under 139(1). So the due date specified under 139(1) is July 31st. If she files the prescribed form of NTR2 on July 1st, on or before, and also files the return on same date, she can exercise the option of opt-out. So scenario 1 is fine. We come, friends, to scenario number 2, that let's say that she's again opting out by filing the requisite form on July 1, 2024, but she's filing a belated return under 139(4) on August 14, 2024. And therefore the question is that what would happen in such case? Will the department take a view that, look, your return is belated and therefore you cannot opt out? To my mind, insofar as the first clause is concerned, the position is that what you have to really focus is whether you have filed the requisite opt-out or prescribed opt-out form on or before the due date of filing return. If that I have complied, then when I actually file the return may not be relevant. That is my view. And therefore, again, in option 2, she can opt out because she opted out of filing the requisite form before the due date applicable to her under 139(1), which is July 31st, 2024. This takes us to the next scenario, friends. That now see, these are all, khayali pulav as I call it, but just to create a debate in our minds. So friends, the point is that now I presume that Ms. Neha was very hasty. She filed a return under 139(1) on July 1, 2024, opted out on July 15th, and then filed revised return under 139(5) in August. Now, what would be a scenario there? Can one take a view that, look, again, I file my return, okay, on or before the due date, which was 31st July, I filed much in advance. Thereafter, I realized that, look, I wanted to opt out. So I again filed in form of opt out on July 15, 2024, which is again prior to my return filing date, and therefore I should not have an issue. Now, friends, it says the declaration to be filed on or before the due date, not along with the return, and which is there in the subsequent clause, and therefore probably she may still be able to opt out. And original return she is filed in time, number 139(1). Insofar as scenario 5 is concerned, I filed a return on July 1st. Now here there's a problem because I opted out on August 3, and therefore I don't think I will get an option to opt out, because the opting out, which is most relevant insofar as business is concerned, has happened has become after the due date under 139(1). I don't think scenario 5 really would be relevant, because if someone is reassessing you, I doubt you can really, at that stage decide to opt out. Now, the last case study we are taking, friends, is where you don't have income from business profession. And let's keep in mind here the language is, if I want to opt out, I should opt out by filing the prescribed form along with the return of income under 139. So now let's say with that background, Mr. Mehul does not have income from business or profession for that year. He is default tax regime. And now let's start with scenario 1. So let's say that he opted out on July 1, 2024, and filed return also on July 1, 2024. So he has opted out along with the return under 2020 on July 1, 2024. So therefore, I don't see there an issue. Second option, opted out on August 14, and belated return also filed on August 14, 2024. Now, friends, here again the issue is this, that he has done along with the return per se, but along with the return to be furnished under 139(1). Now here, open controversy, can one take a view that, look, if I follow Punjab and Haryana High Court, and since there is no reference to the due date, it just said that to be furnished under section 139(1). If one takes a view that 139(4) is an extension of 139(1), and then takes a view together on a holistic basis that everything is filed along with it, then probably one may be able to say that I can still opt out. In scenario number 3, I have opted out on July 15, and then filed belated return on August 3 to 2024. So now, friends, in this scenario, we have said that, look, I have opted generally within the due date which was applicable to me, and it is my return is even filed belated. Now here the point is, if I otherwise complied within 139(1), I may still be able to say that I have opted out. However, the next scenario is a bit difficult, because here I am saying that, look, along with the return. So once I have filed the return in scenario number 4, and then I opt out, I don't think that is permissible. So scenario 4 I would not get, and scenario 5 also I will not get this. So friends, with this I have come an end to the presentation. I will just address one last point which I thought I had in my mind, and it's an open controversy. I think it's an open controversy, frankly, is that some discussions happen in our office, and to say that, look, what happens, first of all, what happens if an assessee has filed a return claiming something to be income from business. So as we are aware, insofar as business is concerned, I have one-time opt-out right now. So I exercise the option of opting out, and then I'm assumed to have opted out for future years, subject to once withdrawal, etc. So let's take a scenario that an assessee has income from rental, and he takes a view that in past also, so far without any discussion or debate and without any scrutiny, his returns are being accepted as income from business. He files a return under the default tax regime, and he also opts out in time. Now the point is, once he opts out for assessment year 20 or 25, because he is himself filing a return to be income from business, he says, okay, since I've already opted out for year 2, year 3, that is next to assessment year, I've already opted out, so I'll just tick mark there and nothing further, no declaration has to be filed. Let us presume that. Now take a scenario in which his case is taken up for scrutiny. And if his case is taken up for scrutiny, friends, and let's say the AO determines that, look, this is an income from house property and not income from business and profession. Now, what are the consequences? Will the department then say that, look, now that I've assessed you as income from house property, in year 2 and 3 specifically, if you did not have income from business, you have to opt out. To opt out, you have to give yearly declaration. Since you did not do anything, for year 2 and year 3, I will recompute an income, assuming that you are under default tax regime. Now, to my mind, in the way the section is worded, and I think department should clarify that in such scenarios, you should go by what the position of return filed by the assessee is concerned. Because we all know, friends, that there are a lot of incomes where there is a debate between the department and the assessee. At times, the assessee will offer as house property, department will classify as business, vice versa. So I think if you go by the conduct of the assessee, at least insofar as the opt-out provision is concerned, it will be much fairer. But this is only something which will come in due course, and one will have to that time address it. So to sum up, friends, I have tried my best to complete in this given time and bring out the controversies, try to explain in an FAQ scenario. The last word which I would say in this is that as of today, the department has not come out with a calculator. I've been given to say for assessment year 24-25. But one will have to really, whenever we have clients or if we are individuals, one will have to really compute in a very systematical manner and then decide whether old tax regime and new tax regime, what is better. Generally, if your deductions are not reaching 3,75,000, and as your income goes higher, I would feel the new tax regime is better. But in each case, one will have to see the income, see the nature, see the expenses, see the exemptions, because see, there are a lot of individual salaried people who would have got certain small house, for which again there is an interest which is allowed under 80 subsection 80E or something. Someone has taken EV, someone's HRA is quite significant, quite expensive. So I think that way one will have to decide and take a call and compute it. So with this, friends, I have come to an end. And before I move on to Q&A, etc., I would like to acknowledge the entire efforts of my team who has really helped me to make this presentation in a very short span of time. So thanks my team members, Gina, Brushti, and other people who have really helped me well. And I will be happy to share with my presentation after the end of this session. So open for questions now.
We request the participants, if there are any specific questions, they can post it up in the Q&A box. In the meantime, there is small announcement to be made. So there is this session which would be conducted, which is a TDS and TCS provision. It is jointly being conducted by BCS and IMC, and it is on 2nd of June. The details you can see over here on the screen, which has been shared across with you. It's a physical. It is on physical as well as virtual mode, and there are a host of speakers wherein the session experts would be leading across. It is both from the industry, from a fraternity, as well as from the department's perspective. So we would actively be anticipating your participation.
Chirag's screen is not visible.
Okay, thanks for mentioning it.
So I think the one question I was just going through, if I can just take it up in interest of time, Chirag.
Sure, Ronak.
So someone has said that family pension 15,000 allowed in new regime. Yes, it is now allowed under a new regime up to 1/3, 15,000. Then what happens in case of presumptive taxation? I think I have answered that in my view, one can opt for presumptive scheme and follow the default tax regime. Generally, it would be beneficial, but it is possible. Then what would be the stand for JVs which are covered under AOP and which are covered under AOP regarding the rate of surcharge, where the members include individual and partnership firms? So I think I understand the question is that this is a genuine case of AOP where people have come together. Now, in this case, in my view, because by default, this AOP being a actual, I mean, formative AOP based on the test of AOP, it would fall within the default tax regime. And therefore, I think in my view, the surcharge should be what is applicable. I mean, there would be a restriction on the surcharge. Mere fact that some partnership firm is also member of AOP, I don't think that should really matter. However, if I remember rightly, the maximum marginal rate definition, I think, includes surcharge. So to that extent, probably if one reads it, that if that includes the surcharge, then a higher rate may apply. Audit return, due date file, application time. So see, friends, insofar as the due date, etc. is concerned, I would feel that one will have to take, see if any due date is extended by the CBDT, or let's say if it was extended by TOLA, etc., under 139(1), then obviously that higher tax limit will apply. And I'm sure there are direct case laws on this, that then even the form which has to be filed on or before that due date also stands automatically extended, unless the department only says that no, a form, they specifically clarify. So, but for that clarification, I think if it's an automatic extension, it would, be fine. On income tax portal, Form 10E is not available for those persons who do not have income from business profession. So, friends, I'll be very frank. I'm not very, so as of today, as I understand, for the assessment year 24-25 forms have not been notified. Insofar as AY 23-24 is concerned, where the form 10I is notified, your question is not available. So what you are saying is that if I'm an individual not having income from business and I want to opt in under the new tax regime 1, the form is not notified. I think if the form is not available, probably the answer is that you still select, if in the relevant form the option is there to opt in, that is generally what I would feel you do it. And thereafter probably file a letter online or offline, which we always recommend as a chartered accountant, that wherever something in the system is stuck and the system is rigid, then whatever is not doable, you do it by way of separate letter. So that would also help. But I think if the form, though the 10I may not be there, if your return form allows you to tick mark, I think you should tick mark that you have opted in. So I don't see any other questions, Chirag and Ketki.
Yes, sir.
I'll request Ketki to give a formal vote of thanks to Ronak.
So first of all, thank you very much, sir. On behalf of CTC and the participants, we wish to extend a well-deserved vote of thanks to you. You have provided a detailed comparative analysis and led us through the nuances of the old and the new provisions. Additionally, you have provided us with a practical insight by way of FAQs, which have definitely simplified the provisions for all. Thank you so much, sir.
Thank you, everyone. Thank you, Chambers, once again.
Thank you, Ronak.
Yeah.
Thank you, sir.
Thank you, Viraj.
Thank you, everyone, for a patient hearing.
Thank you, all the participants.